Welcome to the 401k Audit CPA Success Show, where we're 100% focused on helping companies across the United States prepare for their 401k audit. If you have 100 eligible participants in your 401k plan, then this podcast is for you.
Hello, and welcome to today's episode. Once again, you have Kim and Jamie here from Summit CPA, and I think today's episode is going to be one of the most popular episodes because I'm sure Kim, as someone who works with 401ks all the time, gets questions about what should I do to plan for my retirement. So we're going to talk about that. And I think Kim's going to have a lot of great tips for you here. And I'm sure I'm going to learn something as well as our listeners. So welcome to the show, Kim.
Yeah, thanks, Jamie, for getting us kicked off here. I think the topic today, I'm going to talk about it from a plan sponsor perspective, but also from an individual perspective. So that could be as a participant, just as a general employee, or just as an individual. I mean, maybe our listeners are listening in and they're wondering for themselves. When can I retire? How do I prepare? What do I do? What are the things that I need to think about? Again, we're going to do this from a 401k plan perspective. So we're not going to talk about all the different things that you might have done outside of your 401k plan, but we're going to kind of focus from that perspective. So, one of the things that I think retirement is one of those things we all kind of look forward to, and we hope it's going to go well. And but it's always off in the future until you get older, and then all of a sudden it seems to have snuck up on you, and so now you're scrambling at the last minute to figure out do I have enough money? Where is all my money? How do I prepare for this? So one of the things that we wanted to talk about was planning as early as possible makes the whole process easier. And that's true regardless of whether you're talking about 401k plan or you're talking about anything else. If you talk to your investment advisor, they'll go through the whole life cycle that if you start early, even if it's a small dollar amount and you accumulate it for your lifetime of working, you're going to accumulate a big pot of money at the end because, of course, it's got time to have all the investment gains throughout all the years, and you can recover from losses, which we all have seen over the last few years with the market going up and down with the pandemic. So you have plenty of time, to recover from that and invest when it's down and do all the things that the investment folks tell you. So, I think that kind of goes without saying, but it's very true in your 401k plan. So one of the things that we encourage both participants as well as employers to talk about is starting early. I know it's really hard when you've just probably graduated from college and you're just starting out, and maybe you're starting a family, and we all know that there's a whole lot of expenses at that time, and maybe you've got student loans too you have to pay off. So again, it's very easy to have that mentality. Well, I know I need to do this, but retirement's a long way away. I'll do it in another year or 2 or 10, and the next thing you know, guess what? It's getting close to retirement, and you don't have any savings. So I can't stress enough the importance of both as a participant trying to find a way to save, even if it's $1, $5, $10, you think of, well, why bother? That's so small, what difference is it going to make? But over time, you'd be amazed. So go in, if you don't believe me, go in. There's a lot of online free calculators. Just go, Google retirement savings, and it'll show you if you put in so much a pay period, it'll calculate for you the estimated amount that'll amount to by the time you get ready to retire based on your current age and, average returns and things like that. So go do it for yourself and you'll see.
I guess my question on this area is again, I know kind of my own story. I heard this advice, same thing when I was getting out of college. Everybody's like, you got to start right away. You got to start your first paycheck, make sure you're contributing to your 401k as long as you're eligible, obviously. But, I remember hearing that advice. And the second advice I heard was, if you can, maximize your match. So that's what I did, is I made sure that the amount I was contributing when I was first out of college was maximizing my match. And then I did that for a long time. And then as my earnings went up, it took me a while to revisit it, but I'm like, why am I still just maximizing my match? And I think, I can't remember how old I was, but eventually I was like, oh, let's try to maximize the amount the IRS will let me contribute. And so I guess the question to you is when would you recommend, obviously looking at it every year is important and identifying how much you can put into your 401k, but at what time do you kind of make those shifts of increasing?
Yeah, I think, if you can look at it annually, and again, depending on your employer, and maybe you get a yearly cost of living or yearly, increase in pay, that's a good time. We also talk about, major life events, just like, an insurance agent will always tell you, whenever you have a major event, like you get married, you get divorced, you have a baby, those are good times to look at your insurance. That's another thing. I think it's a good time to look at this, because if you're getting married, then your planning for retirement might change depending on what your spouse is earning. And same thing with children. If you're planning on, adjusting your will for your children, that may influence your plan. So I think life events are a good time to take another stock of it. Another good way to think of it is as you're aging in the decades. So as you go from 20 to 30 to 40, that's another good way to look at it, because that obviously you're getting closer to retirement. We also tell people to take a look at it every time you have a pay change. So that could be obviously a pay increase, or maybe you change jobs, you change positions. So maybe you get an increase, you go from one level to another. Those would obviously be times to look at it, but also consider other things that happen. So what if you get a bonus? What if you are on commission and you get a large commission for some event? Those are other times to take a look at. Number one, what can I contribute out of that? And there are rules in your 401k plan around that. So you're going to have to consult with whoever in HR handles your benefit plan, to make sure that you can take advantage of it. But you could contribute out of those types of things, but also there might be a match opportunity. Maybe there's a profit share opportunity at your company plan. So those are all things to take a look at. Maybe you want to take advantage of it. Maybe you need the money for the bonus for something else. So maybe this time you don't want to, but those are all things I think they're good times to consider. So you always want to kind of be doing it on a regular basis, but it of course is driven by your income.
Yeah.
So those are good times whenever there's a change in your income to consider, is now a good time for me to increase contributions. Let's look at what does that do to the employer side of the contribution too.
And I think all those facts you laid out, I think it's the important part there is don't be afraid to ask the question. If you don't know how a bonus in your company is going to be matched or how a bonus in your company is going to be withheld from, but just ask, especially if you see one coming, and try to be ahead of it, because you make sure you're handling that correctly, because you never know, like different companies handle it differently, and you want to make sure that you're aware of how much you're putting into your retirement.
Absolutely. Yeah. And we also advise talking with an investment advisor if your plan probably has one that they're using. And a lot of times they'll just offer them up to employees as well to talk to them, so that, they can help you forecast, if I would defer on the bonus or I don't, what is that going to mean to my overall retirement savings in the long run? So they can kind of help guide you through that. They can help you with the calculations and things like that. So another good thing we always advise.
Yep, great.
Another thing that we like to bring up, I get a lot of questions about Roth versus pre-tax. There's two main ways, and this would be your contribution, not on the employer side, but from the employee side, two different ways you can make your contribution pre-tax. You're contributing a dollar amount or a percentage of your compensation into your plan. That's going to come out pre-tax. So that's going to help your taxable income when you go to file your tax return. So a lot of people want to do it pre-tax. They figure by the time I get to retirement, I'm going to be in a lower tax bracket. So it's going to benefit me to do it on a pre-tax basis. The other option, though, is what's called a Roth contribution, which is after tax. So it's just kind of the flip side of that. Obviously, the tax is going to be paid already. So by the time you get to retirement, you don't have to worry about what kind of tax bracket am I going to be in and how much per year, is going to impact my taxes. So if if you have the ability maybe to split between pre-tax and Roth, that might be something to consider. If you've got other investments, so you're making investments to your retirement outside of the 401k plan, maybe inside this particular plan you want to consider Roth, or maybe in your other investments you want to consider Roth. So splitting them we think is a good idea if you can. We also see a lot of people that will switch employment over time, and so maybe they've got different 401k plans in different places. Consolidate them if you can is always a good idea, but regardless, you might have some already in pre-tax. Maybe from here forward you want to consider Roth. So those are things, and again, that's something that can get kind of complicated. So I would suggest for the average person, talk to your HR rep, your benefit advisor, or again, if you have that investment advisor, they can kind of help you figure out what do you have already. What is it looking like by the time you get to retirement? How close are you to retirement? Does Roth make sense? But those are things that we always encourage people to take a look at.
Okay, so I have a couple questions here and a couple different topics you brought up. So the first is on the consolidation. So I, obviously, before I worked at Summit, I worked at a couple different jobs, and my wife worked at other jobs as well. And so we did a consolidation recently, and the advantage to me was it was really nice just to have all my investments in one place, and it was a lot easier to track. Other than that, what other advantages are there to doing the consolidation?
Yeah. I mean, that's a big one. It's just, it's much easier, and you don't have to track as many investments and how are they doing, and should I be changing out of this investment? So managing 20 instead of 100 obviously is a lot easier. Yeah. But the other big thing is fees, because there are always fees associated with the plan, and you may not see them. They may be hidden in what we call fee revenue sharing. So you kind of have to dig in. Again, I wouldn't try to do that yourself. I would ask, because it can get kind of confusing. But obviously, if you're getting fees off of one plan, it's going to be a lot less overall than 2 or 3 plans. I mean, it just makes sense. And they all have fees. So if anybody's telling you, oh, no, there's no fees, well, they're not telling you the truth, because there's always fees.
No one works for free, right?
No, absolutely not. So I think that's another reason to consolidate, because that way your fees are just being charged out of one account versus multiples. So
that makes sense.
So definitely things to consider. The other thing I would say against consolidation, though, to consider is what you have, what options do you have versus where are you going to put it? Mm-hmm. So if you're going from a plan that's very good, has a lot of options, you really like the investment choices, going to something that maybe is not as robust, maybe you don't like the investments, that might be, arguing against consolidating. So again, there's always more than one thing to consider. So.
Makes sense. So my second question is, let's talk about limits a little bit. So I mentioned earlier about the IRS limit on the 401k. So if I'm maxing out my 401k, how much am I allowed to put into a Roth? And again, a lot of times when I invest into a Roth, I put it outside of my obviously my 401k plan. It's a separate investment account. But what is the maximum amount I can put into a Roth if I'm maximizing?
Yeah, the limits change every year. Mm-hmm. Congress takes a look at, and there's all different kinds of limits too. So there isn't just one.
Right.
But so I would just go out and just Google it. What's my contribution limit to a 401k plan? And that'll give you the most current limit. There's a set amount for a person. So an individual can contribute a maximum amount each year into, if you would happen to have more than one 401k plan. So let's say you switched employers mid-year, it's a total per year so it's not that amount at one employer and then you get the second amount at another. It's a total per year. Mm-hmm. And that's total regardless. So you don't get an amount pre-tax and then another amount Roth. It's a total regardless of total pre-tax, total Roth, or a split. It's that same amount.
Makes sense.
Now, the one exception to that is if you're over age 50, once you hit 50, and then, of course, every year after that, and you're still obviously employed, they allow you to contribute a little more. It's called a catch-up contribution. And that amount, it varies. I think it's up, I don't have the numbers in front of me, but I think it's up around $6,000 extra. And again, that amount gets looked at every year along with all these other limits. And so you'll want to double check that limit amount for whatever year we're we're talking about, but that gets added into the individual limit. So if you're over 50, you get to contribute a little bit more because they realize you're getting closer to retirement. They want to allow you to, to accumulate more. The other thing we want to talk about, though, when we're talking about contributions, as I mentioned, there are a lot of different limits. So there's limits on you as an individual. There's limits for you as an individual in total. So that includes what your employer is contributing on your behalf, along with what you've contributed. So again, those are things probably your employer will look at for you. But there is testing at the plan level that's required. It's called discrimination testing. The IRS, because most people use the pre-tax option, which means that you're not paying tax on that money at the time that it's earned, which obviously then the federal government isn't getting that money right away. They get concerned if employers are trying to use the plan to benefit the people at the top. So if that's owners or that's the senior managers, the people that are making usually the most money, and they're trying to use the plan to benefit their tax positions. The IRS obviously doesn't like that. They don't want that to happen. So they require plans under certain circumstances, and it gets kind of complicated here. We're not going to get into all the details, but under a lot of circumstances, they have to do something called discrimination testing. And there's a lot of calculations. They get very complicated, but it's comparing one group to another group. So it's those highly compensated folks, how much are they contributing versus everyone else? And if the calculation doesn't come out quite right, you fail that test. And then one of the ways that you can correct that is something called excess contributions, which means you as a participant may get a refund of some of your participant pre-tax contributions, which then of course means that you'll have to pay tax on that money because the tax wasn't withheld at the time you originally contributed to it. So if you're a highly compensated person, you're either an owner or maybe you're one of the senior managers at your company, or you're just highly compensated in comparison to everyone else. And again, if you're not sure, ask your HR rep. They'll be able to tell you if you fall into that group. Then you want to be careful about that because that's not a good thing to put money in as pre-tax. You're not going to find out until the following year. So now, you may have already done some tax planning. That's going to get messed up because now you're going to owe tax you didn't know that you were going to. And so it's not a good thing. So what we recommend here is double check with your HR rep, find out, are you in this group? If you are, did they have excess contributions in the past? Does this topic apply? Because there are situations it doesn't apply. So if it does, then find out. There are ways that you can spread out your contributions and you're maximizing the match, but you're not going to run over that excess contribution. So it's kind of a complicated topic and we don't have time to go into all of the ins and outs of it, but I would recommend just get with your HR rep if you think you fall into that group and then ask for some advice.
And just to, chime in here a little bit. So I have a client that had excess contributions this year. And I know we've talked about this in previous podcasts, but I think this is the importance of having your participants, your employees participate in your 401k plan. I know we had a whole podcast on that, but this is one of the reasons it's really important is because if you have a 401k plan offered for your whole company and only 4 people are participating and they're all your top employees, then their contributions aren't going to matter. And they're going to have to go back and do exactly what you just said. So I think that it is important if you plan on opening a 401k plan for your employees to make sure people are participating so you don't run into this because it can be a problem. And then like Kim said, it's not a problem until the test is done. And then it's a year later and you're like, oh, wow, we did this awesome benefit for our employees. Now we're having to give it all back. So
yeah, that's right. That's right. And if you're a plan sponsor and you're listening to this, or you're maybe in HR, it can become a problem for you because just think of who are those people that are getting that refund that you're creating a problem for. They're not the people that you want to get angered over a compliance issue. So it is something we recommend everybody take a look at and just be aware of, look out for it. Planning, as you mentioned, is the key in communication.
It's not a fun conversation to have. I can tell you again,
no.
I'm not even an employee of the company. I'm just someone that had to deliver the news to my client and say, oh, by the way, your VP of marketing and your VP of this, their 401k did not matter this year. So.
Yeah. Not a good conversation. The next area we wanted to talk about, kind of switching gears a little bit, is talk about retirement age. So we mentioned start early and look at it as you're going through your working life. But when do you start really caring about this? When does it really matter? And obviously, as you're approaching retirement, that's when you really start looking at this, as really paying attention, and it really matters to you. One thing, people kind of determine their retirement by Social Security. That's kind of how we all talk about retirement these days. Social Security ages, of course, vary, and they're going to be ramping up over time. One of the ways that they're adjusting the Social Security fund is by requiring you to work longer. So we kind of talk about 65 as a Social Security age, but obviously it's going to vary depending on if you take it early, take it later, and obviously when you're retiring and as those ages ramp up. But let's just say 65 for discussion purposes. Don't assume in your 401k that retirement age is the same, because it may be. They may use the Social Security age, or they may not. They can define their own age. So double check that as you're approaching your retirement and you're starting to do planning prior to reaching your retirement age. Is that'll factor in. I mean, you can leave the money in. You don't have to take it out once you hit a retirement age, but you may want to. You may want to start taking money out. Maybe you'd prefer to take money out of your 401k and leave it in Social Security a little longer. So that's a number you need to know, is what's the retirement age in your 401k plan. And then, of course, you're going to do some retirement planning as you get approaching your retirement age. So that's a number you're going to want to know and to factor it in. If you try to take the money out before you hit that retirement age, you can incur a penalty. So that's why you want to know about that. Another thing you want to check is, does your plan allow what are called in-service withdrawals once you reach the age of 59 and a half? That's another important date. Some plans allow this. A lot of them actually are starting to allow it, but some don't. So don't assume that your plan allows that. It becomes important if you're getting close to retirement, and let's say you lose your job, or maybe you have a job reduction, so you're not making as much money. Maybe you want to start taking some money out of your 401k plan because you can't out of Social Security yet. Or maybe you just want to retire a little early. That is an option that you might want to consider. So again, check with your HR rep and find out, is that an option for you? It's a good thing to know, even if you don't think you might need it, just in case, because you never know. Things happen. And then the last age you want to consider is the required minimum distribution age. So you've had this money sitting in your plan. You're getting ready to retire from your job. You can start taking the money out once you retire. And again, you want to check your plan document in terms of what does it say about, do you need to start taking money out? But the IRS requires you to begin taking money out of your plan once you hit a certain age. Now, that age used to be 70 and a half. It's changing to 72. And we've got a congressional act that they're working on, which we are expecting them to implement here probably in 2021, that will, we're guessing, increase that age again. Not there yet, but we are increasing that, or we're expecting that. Also, there is a regulation for COVID that allows you to not have your required minimum distribution due to COVID, unless you want to. You can still do it if you want to, but you're not required to do it. But in general, once you reach that required minimum distribution age, you're going to set up a plan that over a period of time, you're going to have to take out so much, so that in theory, by the time before you pass away, you're going to have exhausted the amounts in your 401k plans so that you'll pay tax on it. That's the reason for it. But that's another thing you want to factor in to all of that requirement planning, because you're going to have Social Security, you're going to have your 401k plan, maybe other investments, and you want to plan that out so that you're paying as little tax as possible. So that's where tax planning comes in.
Yeah, I agree. I think that's the big word there, is planning. Is you need to understand all these ages, all these numbers. You need to understand how much you have in there, and really plan out of, okay, if I tried to retire at 55 and a half, can I even get my money out, and how am I going to get it, and what's it going to look like? Or if I waited till 66, all those things you want to make sure that you're planning and understanding as the closer you get to retirement, for sure.
Right, right. And you also want to make sure you're following the rules of the plan because there are penalties. If you try to take the money a little early, you really planned it, you needed it at this point in time. And so now you have to take it and, oh, whoops, there's a penalty. That'll eat away at your plan assets. So
you'd hate to do everything right. Invest early, make sure you're getting the maximum investments, make sure you're getting the match. And then all of a sudden you're taking it out and getting these penalties that basically get rid of all all the things you did.
Right. Exactly.
So I'm gonna throw our email address out there real quick. Again, we're always looking for new topics. If you want to join us and be a guest, I think this, like I said, this show will probably have a lot of questions. So I would love for you to email us and ask those things. We're always here to help. So our email address is audit@summitcpa.net. Again, audit@summitcpa.net. Would love to hear from you. So Kim, any other things we need to consider when investing in our 401k plan?
I don't think so. Just, invest as early as you can, stick as much in there as you can, know your rules, and also watch the investments. The market moves, as we all know. So it is a big chunk of money if you've been investing. So watch what's going on with your particular investments and the market in general and kind of plan accordingly. Those are the big things to watch.
Yeah, and utilize the resources of your company as well. So I think that's the other thing is, we've mentioned a lot of resources here, HR department, investment advisors, make sure you're utilizing everything that they give to you, because it really is just good to talk to someone, say, hey, this is what I'm doing. Does it make sense? And, get their opinion from someone who's kind of involved with these type of things is really helpful.
Absolutely. Yep.
Great.
They're free resources. Why not use them?
Exactly. Awesome, Kim. Well, I definitely appreciate the topic today. And like I said, I think a lot of our listeners are really going to buy into this. So appreciate your help.
Thank you, Jamie. And I guess that's it. Until next time.
Yep. Thank you.
Thank you.
Enjoy this episode? Visit our website at summitcpa.net to get more tips and strategies for achieving modern CPA firm success. We're here to be a resource in this ever-changing industry.